Okay, good day everyone. We are here in the financial management or your BAFM1. So we are down in the chapter 1. So are you ready guys? Okay, let's go. So these are the learning objectives of this lesson for this hour. Okay? So first is the overview of financial management, the overview of business environment, the corporate structure, and important business trends. Okay? So last meeting, we already talked about the course output, a course outline of this subject, the financial management, the course description of financial management, your term output, and a brief overview or brief discussion about this subject. So first, let's talk about what is finance. So finance is a term that refers to, yes, two main activities. So which are the actual process of attracting money and the management of this fund. So it is a broad term that describes activities which banking, leverage of debt, credit, capital markets, money, and investment. So basically, finance represents money management. So and the process of acquiring needed funds. So finance also encompasses the oversight, creation, and the study of money. So banking of credit, investments, assets, and liabilities that make up of financial system. So we have the finance function has been classified into three. We have the long-term, the medium-term finance, and lastly the short-term finance. So when we say long-term finance, this includes finance of investment 3, okay? Investment 3 years or more. So sources of long-term finance include owner capital, share capital, long-term loans, debentures. So internal funds, and so on. So when we talk about medium-term finance, so this is financing done between 1 to 3 years. So this can be sourced from banks, bank loan, and financial institution. And lastly, your short-term finance, this is finance needed, correct, below 1 year. So funds may be acquired from bank overdrafts, commercial paper, advances from customer trade, and etc. Okay, let's proceed with the objective of finance function or the types of financial decision. So we have investment decisions, financing decisions, dividend decisions, liquidity decisions, and lastly the asset management decision making. So when we talk about investment decisions, so this is where the finance manager decides where to put the company funds, investment decision relating to the management of working capital, capital budgeting decisions, management of mergers, buying or leasing of assets. So investment decisions should create what? Okay, correct. Revenue or profit and minimize the cost. Okay? Or save cost. So next is your financing decision. So here's a company decides where to raise funds from. So there are two main sources to consider, mainly your equity or borrowed. So from the two, a decision on the appropriate mix and or short and long-term financing should be made. So the sources of financing best at a given time should also be agreed upon. And the third one is the dividend decision. So these are decisions as to how much, how frequent, and in what form to return cash to owners. So a balance between profits retained and the amounts paid out of dividends should be decided here. And the fourth one would be the liquidity decision. So liquidity means that a firm has enough money to pay its bill when they are due and have sufficient cash reserves to meet unforeseen emergencies. So this decision involves the management of the current assets so you don't have insolvent or fail to make payments. And lastly, the asset management decision making. So, can therefore be taught as of of as the strategic manipulation of asset information to determine the optimal mix of financial and non-financial strategies to enable the asset portfolio to deliver the asset management objectives of the organization. So that is your types of financial decisions. So next is why a business needs the financial function. So we have four different reasons. The first one is to help establish a business. So without money, you cannot get labor, land, and so on. So with the finance function, you can determine what is required to start your business and plan for it. So the next reason is to help run a business. So to maintain in business, you must cater to the day-to-day operating costs such as paying salaries, buying stationery, raw materials. The finance function ensures you always have adequate funds to cater to this. And the next reason is to expand, modernize, and diversify. So a business needs to grow, otherwise it may become redundant in no time. So with the finance function, you can determine and acquire the funds required to do so. And lastly, to purchase assets. So you need money to purchase assets. So this can be tangible assets like furnitures and fixtures, building, cars, intangible like trademarks, patents, and etc. So to get this, you need finances. So that is the reasons why business need finance function. Next is the importance of finance function. The first is to identify need of finance. So to start a business, you need to know how much is required to open it. So the finance function helps you know how much the initial capital is. So how much of it you have or how much you need to raise. The next importance is to identify sources of finance. So once you know what needs to be raised, you look at areas you can raise these funds from. So you can borrow or get from various shareholders. The third one is the comparison of various sources of finance. So after identifying various fund sources, compare to the cost and risk involved, then choose the best source of financing that suits your business needs. And lastly, investment. So once the funds are raised, it is time to invest them. So investment decision should be done in a manner that a business gets higher returns. So cost of funds procurement should be lower than the return on investment. So this will show a wise investment was made. So the finance functions involve ensure enough funds at a reasonable cost, ensure safety of funds, ensure efficient, effective, and profitable utilization of funds, to ensure the finance funds don't remain idle. So that is the finance functions involves. So next is the areas of finance. So we have three different areas of finance. First is the business or corporate finance. So when we talk about this is the firm's ability to make good financial decisions. So next is the personal finance. So this is the retirement provision, savings plans, and etc. And the third one is the public finance. So these are the income distribution, stability plans, or where your tax was disputed, and so forth. So these are the areas of finance. The three areas. Okay, let's proceed with the difference of finance and accounting. So there are in this portion we have the point of difference in terms of definition, approach, responsibility, skill set, subject proficiency, outcome proficiency, outcome statements rather, objective and interdependent. So and definition, so financial accounting concentrates on record keeping and submitting of FS or your financial management. While for the finance, they focus on decision making and carry out analysis based on information presented by accounting. Okay, so in terms of approach, finance Financial accounting tends to be more concerned with the past, while the finance tend to be more interested in present and in the future. So as you can see here in the approach, accounting is backward looking while finance is futuristic and forward looking. So next is in terms of responsibility, accounting is statutory compliance and tax liabilities, while for the finance, forming strategies for creating value for investors. So in terms of skill sets, accounting is detailed and procedure oriented. They are well informed of applicable statutes and accounting standards. They are conservative and modest in recording anticipated profits. They are rule-based thinking, and lastly, they are strong quantitative and computation skills. So in terms of finance, they are research-oriented and analytical inclination. They are well informed of current market and industry situation. They are risk-taking or risk-taker, out-of-the-box thinking, and lastly, results and profit-driven. So in terms naman of subject proficiency, usually accounting are in line with this: auditing, taxation, business law, management accounting, and cost accounting. While for the finance, corporate finance, derivatives, capital markets, portfolio management, and financial modeling. So for the outcome statements, so accounting, doing the balance sheet, profit and loss accounts, cash flow statements, or your cash flow, profit and loss, or your income statement, cash flow statements, depreciation schedules, budgets, okay, cost allocation statement. While for the finance, they are doing capital budgeting, the working capital management, the investment policy statement, the ROI computations, forecasting schedule, and leverage analysis, and etc. So the objective of accounting is tends to have an income focus, or they check on the state of affairs, determination of profitability, shareholders, and creditor confidence. While for the finance, they are tend to have a cash flow focus, or focusing on profit and wealth maximization, reducing cost of capital, and steering future action. And lastly, for the interdependence, the accounting team actively supports the financial team. That's correct. By supplying them with accurate and relevant stats of the company. So, while for the finance, so the finance management sets the phase for operations within an entity. So, it determines the vigor with which the targets are to be chased. Okay? So let's proceed with the goals of the business. We have 3 goals. First is the target of business is to maximize shareholders' wealth. Next is it measured as the price of stocks. And lastly, wealth maximization concept adjusts for deficiencies of previous concepts. So let's compare the profit maximization and wealth maximization. So in profit maximization, it means it's short-term oriented, it cannot account for risk, it can lead mismanagement. While for wealth maximization, it is long-term oriented, the risk factor is taken account, and lastly, recognize the timing of return. So it means that the wealth maximization is more appealing than profit maximization. Okay? So let's proceed with the security. With the security fee, cut. Okay, let's proceed with the, okay, so let's proceed with the security features of, so let's proceed with the security features of money. Next, so an overview of business environment. So we have 3 types of business. Okay, you already noticed these are already introduced to you in your first years, maybe, or in your secondary years. So, but let's have a brief overview about the 3 types of business. We have the sole proprietor, the partnership, and the corporation. So first is what is a sole proprietor. So a business that owned and operated by one individual, the owner and the business are legally identical. So the pros and cons of sole proprietorship is first, the pros, limited paperwork and startup costs, owner's full control over the business, less stringent reporting obligation, while for the cons, unlimited liability for debts, difficulty in fundraising, and business continuity concerns. Next is the partnership. So partnership is a business that owned and controlled by, correct, two or more persons who are equally liable for losses. So typically governed by partnership agreements. So these are the pros of partnerships. First, there is a shared between the partners, additional capital can be raised, no audit or public reporting requirements, not subject to company tax. While for the cons, it is unlimited liability for debts, administrative costs, business continuity concern, and slow decision-making process. And lastly, the corporation. This is business that owned by the shareholders. So shareholders' liability is limited to nominal value of shares that they own. So business is legally separated from its owner. So the pros of corporations are less risky, fundraising advantage, separate legal entity from its shareholders, tax benefits, and transferable form of ownership. While for the cons, publishing financial statements, strict reporting obligation, administrative issues, double taxation, and legal restriction on share issues or in the LLC, or limited liability corporations. So, role management, an agent in an individual authorized by another person called the principal. So, to act in the latter's behalf. So, for the agent theory, principal must provide incentives so that management acts in the principal best interest and to then monitor the results. So, incentives includes the stocks, options, perquisites, and bonuses. Okay? So, the modern corporations look like this. Okay? Sabi nga kanina, a shareholder is separated from the management. Then, as you can see in the organizational chart of the corporate structure, the highest point there is these shareholders, while the next is the BOD, or your board of directors. The next is the CEO, or the chief executive ownership officer, and the next CO, or chief officers, and the middle employees, and the rank and file employees. So, let's proceed with this next topic, which is the stock prices and intrinsic value. So, what is a stock price? So, the term stock price refers to the current price that a share of stock is trading for on the market. So, every publicly traded company, when its shares are issued, are given a price, an assignment of their value that ideally refers the value of the company itself. So the price of stock will go up and down in relation to a number of different factors, including the changes with the company as a whole. So changes with the industry, political events, war, and environmental changes. So the stock price changes for a company. So aside from the other things that make stock price changes, there can be an issue within a company that cause its stock price to move in either direction. So we have different reasons here because of first, law of the supply and demand. So if a company produces a good that not many other produce, or a good that is highly desired or necessary, the price of its stock will climb because the demand is high. As we all know, in the law of demand and supply, the higher the demand, the higher the price. So when the supply of the goods balances out with the demand, stock prices will tend to plateau. So if the supply is greater than the demand, unfortunately, the share price of the company will likely drop. So it also depends on how effectively and uniquely the company produces the goods. If they create a variation on an old standard, so their share price may stay the same or increase even if supply is high. Okay? Next reason is the management or production changes. The changes in management or production can also cause a company share price to rise or fall. So it depends on how effectively or and efficiently the company is managed and goods are produced. So changes to the management team styles and how goods are produced can boost efficiency and thus overall effectiveness. So increasing profits and causing the share price to rise. So however, negative changes can result in the exact opposite effect. And lastly, to mention the company's name. So one other points of note that can significantly affect the stock price is to mention of the company name in the news, okay, or giving your brand image in the public news, social media, and by word of mouth. So it is specifically in regards to one of two events. So it's either scandal or success. So scandals, to or not, can cause company share price to drop. Yes. Simply by being associated with anything negative. So also being connected to or responsible for a breakthrough or the success either in the market or respective industry will usually cause a stock price to increase. So stock price, earnings, and shareholders, stock prices are first determined by a company's initial public offering, okay, or your IPO. That is the price, the first price of the stock, of your stocks in the market. Okay? So when it put first its shares into the market, so investment firms use a variety of metrics along with the total number of shares being offered to determine what the stock price should be. So afterward, the several reasons mentioned above will cause the share price to rise and fall. So driven largely by the earnings that can expected from the company. So traders are use financial metrics constantly to determine the value of the company. So including its history of earnings, changes in the market, and the profit that it can reasonably be expected to bring in. So it will cause traders to bid share price up and down. So traders aim to make a return on their investment. It is done in two primary ways. So first is through dividends. So if the company stock pays dividends, regular payments are made to shareholders to every share held. So next is purchasing shares when they are at a low price and selling them back once the price goes up. So a stock price is a given for every share issued by a publicly traded company. Okay, publicly traded company usually in PSE or in Philippine Stock Exchange. So the price is a reflection of the company's value. So what the public is willing to pay for a price or piece of the company, it can and will rise and fall based on variety of factors in the global landscape and within the company itself. So let's proceed with the intrinsic value. Okay, you can see in your monitor or in your screen that that is the formula of is intrinsic value. So what is an intrinsic value? Intrinsic value of a business or any investment security is the present value of all expected future cash flow. It's counted at the appropriate discount rate. Unlike relative form of valuation that look at comparable companies, intrinsic value looks only at the inherent value of business on its own. So another way to define intrinsic value is simply the price a rational investor is willing to pay for a given investment. So, given its level of risk. So, in its background, Benjamin Graham and Warren Buffett are widely considered the forefathers of value investing, which is based on the intrinsic valuation method. So, Graham groups the intelligent investor laid the groundwork of Warren Buffett and the entire school of thought of the topic. So, in terms of intrinsic, the essential nature of something. So usually these are the innate, inherent, native, natural, deep-rooted. So there are different variations of intrinsic value for formula, but the most standard approach is to similar to net present value formula. So NPV means net present value. The FV is the FVIJ is your net cash flow for the J period or the initial present cash flow. I is your annual interest rate, and lastly for the N is the number of periods included. So variations include multi-stage growth, models, and assigning a probability or level of certainty to the cash flow and playing around with the discount rate. So risk adjusting the intrinsic value. So the task of risk adjusting to cash flows is very subjective and a combination of both art and science. So we have two main methods here. So discount rate and certainty method. When we talk about discount rate, using a discount rate, the includes a risk premium and an adequate discount to the cash flow. So in discount rate approach, a financial analyst will typically use a word weighted average cost of capital or WACC. So the rationale behind this approach is that if a stock is very volatile, it is riskier, okay, investment. So therefore, a higher discount rate is used, which has the effect of reducing the valuation of cash flow that would be received further in the future. The next is the certainty factor. Using a factor of scale 0 to 100, certainty of the cash flow in the forecast materializing. So the approach is believed to be used by Warren Buffett. So a certainty factor or a probability can be assigned to each individual cash flow or multiplied against the entire NPV of the business. So as a means of discounting the investment. So in this approach, only the risk-free rate as the discounted rate since the cash flows are already risk adjusted. So at the end of the day, both methods are attempting to do the same thing. So what would be that thing? So to discount an investment based on the level of risk inherent in it or included in that. So there are different challenges of intrinsic value. So the trouble with calculating intrinsic value is it's very subjective exercise. There are too many assumptions that must be made and the final net present value is very sensitive to changes in those assumptions. So each of the assumptions in the WACC can be calculated in different ways while assumption around a confidence probability factor is entirely subjective. So essentially, when it comes to predicting the future, it is by definition uncertainty. So for this reason, all of the most successful investors in the world can look at the same information about a company and arrive at the total different figures for its intrinsic value. So we have different forms of valuations. We have the technical analysis, relative valuation, and the cost approach. When we talk about technical analysis, involves looking at charts and evaluating various indicators that may signal a stock is going to go up or down in the short to medium term. For example of this is your candlestick. Candlestick in the market, in the stock market, that is the vertical rectangular chart dun sa stock market. Yun yung candlestick. So, Aside from that, momentum and moving averages, relative strengths, and so forth. And while for relative valuation, looks at what other investors are willing to pay for a similar investment and assumes that they would pay a comparable price for the company in question. So the two most common example of this for comparable company analysis is the comps and predecessor transaction analysis. And lastly, for cost approach, in this cost approach, an investor looks at what the cost to build or create something would be and assumes that it is what it's worth. So they may look at what it's cost others to build a similar business and take into account how costs have changed since then. So we have the inflation. What is the opposite of the inflation? Correct, the deflation, input costs, and so forth. Okay, so let's proceed with the last topic, which is the important business trends. So, business trends changes because of the wants, the needs, and the taste of the consumer change. So, there could be a number of reasons for this, but the fact that it happens at all is that only reason you need to begin understanding why is it happening. So since the customer is what drives you your company's success, you want to make sure that the product and services are always in line with what they want and needs. So there are no way that a business would be able to stay relevant or in some cases even exist without knowing about how the customer is spending his or her money with that in mind. So one of your business processes should be staying current with developing trends and making sure that you devote some of your marketing efforts to taking advantage for those trends. So we have tips for identifying trends. So some of the different things that you can do include network with others. As the leader of your business, it's important for you to make connections with others. Yes, correct. Doing so will allow you to take advantage of a wider variety of resources and insight that could prove useful. Next would be to study relevant websites and blogs, identifying business trends that could. This method can be particularly easy because there seems to be a site or blogs for just about anything you can think of. So find some of the related to what you do and compare them with the similar team site. Third is do some market research. So if you want to get information straight from the source, then you should set up some way of gathering information right from your customer. So try sending out surveys, providing polls through social media, and so forth. And lastly, look at industry leaders. So leading companies in your industry may be in their position in part because they jump on trends before anyone else. And how to improve business trend awareness skills. So the following are some ways you can improve business trends awareness as a skill and step into path of successful. First, start with yourself. Okay? Always begin by identifying trends in your own business before moving to those of others. So next is carefully observe your competitors. Your competitors are usually the best source of information. So regarding the news business trends. And lastly, attending conference. So taking part in the local events and signing off training sessions are some of the opportunities for networking. So face-to-face discussion with colleagues can also be very insightful. So that would be for today, guys. So I hope you absorb some knowledge or informations about this topic. And that's all. Thank you. See you again in the next chapter. Bye, everyone.